If you have spent any time on financial YouTube, you have probably been told that retiring at 40 requires one of three things: a lottery ticket startup, a windfall from rich parents, or a secret strategy that, conveniently, the person telling you about it is selling for $99 a month. I want to argue that all three of those framings are wrong. Retiring between 35 and 45, without inheriting money, without a viral business, without anything you cannot replicate from a normal salary, is, in fact, possible. It is also far less exciting than the internet wants you to believe. There is no trick, there is no edge, there is a system, and the system has been sitting in plain sight for about 100 years, supported by some of the most rigorous data in finance. What I want to do in this video is not sell you on that system. I want to walk you through it the way a researcher would. We will look at the math of compounding, including the parts that are uncomfortable. We will look at why individual stock picking, statistically, does not work for almost anyone, and we will look at the actual academic study that proves it. We will look at why index investing wins by default. We will look at the one strategy that lets an ordinary salaried worker turn a high market into an opportunity rather than a trap. And we will look at how to actually withdraw the money once you get there, because the exit, it turns out, is harder than the entry. I will be citing sources throughout. Bessembinder at Arizona State, Bengen, the creator of the 4% rule and what he updated it to last year, Shiller's CAPE ratio, which right now is at the second highest reading in over 140 years of U.S. market history, Buffett's 10-year bet. None of this is hidden knowledge. It is just rarely assembled in one place. If by the end of this you decide the plan is not for you, that is a legitimate conclusion. But you will have decided it from evidence, not from a thumbnail. Almost every conversation about early retirement begins in the wrong place. It begins with savings. How much should you put away each month? What percentage of your income? How aggressively to cut expenses? These are not unimportant questions, but they are downstream of a more fundamental one. What is the unit you are actually trying to preserve? The unit is not dollars. Dollars are a measuring stick that is itself shrinking. The US dollar has lost roughly 87% of its purchasing power since 1971, the year it was decoupled from gold. If your great-grandparent buried $100,000 in cash in 1971 and you dug it up today, you would be holding something with the purchasing power of about $13,000 in 1971 terms. The cash did not move. The ground beneath it did. So the actual question is not how much you save. It is whether your savings are growing faster than the ground is sinking. Cash is not a neutral choice. Cash is an active decision to lose ground every year, a quiet, polite, compounding loss. Compounding cuts both ways. The same exponential force that erodes cash also magnifies anything that outpaces inflation, and the magnification is not linear. It is geometric, and geometry is far more violent than most people's intuition is ready for. Consider a 30-year-old with $100,000 invested at a 10% annual return, approximately the long-run historical return of the S&P 500 with dividends reinvested. After 30 years, that $100,000 becomes about $1.74 million. After 40 years, $4.52 million. Notice what happened. The first 30 years produced roughly $1.6 million in gains. The next 10 years alone produced almost $2.8 million more. Compounding accelerates with time because every additional year compounds on a larger base. This is why Warren Buffett's wealth is overwhelmingly a function of his age, not his cleverness. The cleverness matters, the duration matters more. Adjust the return rate, and the geometry gets violent. 11% instead of 10, a single percentage point, and that same 100,000 becomes roughly 2.29 million after 30 years. Or 6.5 million after 40. 1 percentage point, over 40 years, is nearly a $2 million difference. Which brings us to one of the simplest fraud detectors in personal finance. The best long-term investor in modern financial history is Buffett, whose compounded annual return at Berkshire Hathaway over roughly 6 decades is somewhere around 19 to 20%. That number is the upper edge of what is physically achievable over a human lifetime. So when somebody, a fund, an influencer, a relative with a system, promises sustained returns of 25, 30, 50% a year, what they are actually claiming is that they have solved a problem Buffett, with all his resources, could not. The probability of that being true is, charitably, very small. The probability of it being a fraud is very large. Inflation erodes. Compounding accelerates. And the headline return rate, however small the difference looks, is decisive. The harder question is how to actually get that 10%. And the answer most people instinctively reach for is exactly the answer the data tells us not to use. When most people decide they want to grow their savings, the first instinct is to buy stocks, not a fund, stocks. They open a brokerage account, read a few articles, and pick 3 or 4 names that sound promising. A tech giant they use every day, an electric vehicle company, whatever was up the most last quarter. This is, statistically, one of the most reliably losing strategies in personal finance. And the most rigorous evidence for that claim comes from a single academic paper I want to walk through carefully, because it changes how you think about the entire activity. In 2018, a professor named Hendrik Bessembinder at Arizona State University published a paper titled "Do Stocks Outperform Treasury Bills?" The question sounds almost silly. Of course, stocks outperform Treasury bills. That is the entire premise of the equity risk premium. Except Bessembinder did not ask whether the stock market outperforms Treasury bills. He asked whether individual stocks do. He looked at every common stock in the CRSP database, the standard academic dataset of U.S. equities, from July 1926 through December 2016, 25,967 distinct companies across 90 years of market history. The findings were shocking even to professional investors. Of those nearly 26,000 stocks, only about 43% had a lifetime buy-and-hold return that beat one-month Treasury bills. Read that again. 57% of stocks, almost 3 out of every 5, underperformed cash equivalents over their entire lifetimes as publicly traded companies. The median individual stock had a negative lifetime return. It gets more extreme. When Bessembinder calculated dollar wealth creation across the entire U.S. stock market over those 90 years, he found that the top-performing 4% of companies, about 1,092 stocks, accounted for 100% of the net wealth created by the entire market above what Treasury bills produced. The other 96% of stocks, taken together, collectively did about as well as holding cash. A follow-up study extending the analysis globally found something even more pointed. Across more than 64,000 stocks in 42 countries from 1990 to 2020, just 2.4% of companies accounted for the entire $75.7 trillion in net global stock market wealth creation across that period. In practical terms, the stock market as an aggregate produces good long-term returns, but that aggregate result is generated by a tiny minority of extreme winners, while the majority of individual stocks are deadweight or actively destructive. If you pick stocks at random, your most likely outcome is not average, it is below average, because the distribution is skewed. The few enormous winners are pulling the index up. If you do not happen to own them, you do not get those returns. The natural response is, fine, I will just try to pick the winners. In principle, you can try. In practice, identifying the next NVIDIA, holding it for 20 years through 80 and 90% drawdowns without flinching, and not selling after the first 10-bagger. This is a sequence of decisions almost no one executes. NVIDIA, the single best-performing S&P 500 stock of the last 20 years, suffered a 90% drawdown in 2002. To benefit from its run, you needed to be holding before the run started, and continue holding through a near-total loss. The number of retail investors who actually did this is rounding error small. There is also a hidden cost that does not appear in any return calculation, the psychological one. Owning individual stocks is exhausting. The price moves every minute the market is open. Your attention gets dragged into news cycles, earnings calls, analyst downgrades, the same cognitive bandwidth you need to do your actual job, learn new skills, and grow the income that funds everything else. The problem with picking stocks is not just that you will probably lose. It is that even if you do not lose, the process will likely cost you more than it pays. There is a better answer, and it has been hiding in plain sight since 1976. In August of that year, a man named Jack Bogle, who had recently founded a small mutual fund company called Vanguard, launched something the financial industry openly mocked at the time. The first index investment trust, later renamed the Vanguard 500 Index Fund. The pitch was almost embarrassingly modest. It would not try to beat the market. It would simply own all 500 stocks in the S&P 500 in proportion to their size, charge almost nothing for doing so, and let the result be whatever the market produced. Wall Street called it Bogle's folly. 50 years later, indexing has become the dominant form of equity investing on Earth. The reason is not ideology. It is 3 structural properties that, once you see them, make the alternative look strange. The first is that an index is, in effect, immortal. Companies die, Indices do not. Of the original 500 companies in the S&P 500 when it launched in March 1957, only about 53 are still in the index today. The other roughly 450 have been acquired, gone bankrupt, demerged, or simply fallen out because they were no longer big enough. The index did not care. As each company exited, a new one took its place. By definition, a company that had grown large enough to qualify. The index has a built-in mechanism that promotes winners and demotes losers, automatically, without human judgment. This is what makes the index a fundamentally different object from a stock. A stock is a claim on a single company that may or may not exist in 20 years. An index is a claim on whatever the largest, most profitable companies in an economy happen to be at any given moment. The first is mortal. The second is, for practical purposes, not. The second property is cost. The Vanguard S&P 500 ETF, ticker VUO, currently charges an expense ratio of 0.03% per year. For every $10,000 invested, that is $3 in annual fees. The competing actively managed mutual fund industry typically charges between 1 and 1.5%, 50 times more. Over 30 or 40 years of compounding, that fee differential alone can account for hundreds of thousands of dollars in lost wealth. For investors outside the United States, the equivalent vehicle is typically the Vanguard FTSE All-World UCITS ETF, ticker VWRA, listed in Ireland, broader than the S&P 500, covering global developed and emerging markets, expense ratio around 0.22%, slightly higher, but in exchange you get a single fund holding roughly 3,700 companies across the entire planet. The third property is the historical track record. From 1957 through the end of 2025, the S&P 500 with dividends reinvested has returned roughly 10% per year, compounded. There are decades it lost money. There are decades it crushed every other asset class. But over the full 68 years, the average is in that 10% neighborhood, the same number we used in our compounding examples. That is not optimistic. It is the actual realized history. A useful illustration. $1,000 invested in Altria, the best-performing stock among the original 1957 S&P 500 components, held for 50 years would have grown to approximately $8.4 million. That is the best stock. The same $1,000 in the S&P 500 index over the same 50 years would have grown to about $168,000, far less than Altria. But you did not need to know in 1957 that Altria would be the winner. You just needed to own everything. That is the trade indexing offers. You give up the chance of picking the one exceptional winner. In exchange, you guarantee that you own it. The most concise demonstration of this entire argument is something Warren Buffett did, almost as a public stunt, in 2007. That year, Buffett publicly offered a $1 million bet to any hedge fund manager willing to take it. His claim was simple. Over the 10-year period from January 2008 through December 2017, a single low-cost S&P 500 index fund would outperform any portfolio of actively managed hedge funds the challenger could assemble, net of all fees. For a long time, there were no takers. Buffett had thrown down a challenge against an entire industry that justified its fees on the claim that it could beat the market. The silence was, in itself, evidence. Eventually, a fund-of-funds manager named Ted Sades from a firm called Protégé Partners stepped forward. He selected 5 separate funds of funds, which collectively invested in over 200 underlying hedge funds. The argument was reasonable on its face. Any one fund might fail, but a diversified basket of skilled professional managers should surely beat a passive index. The 10 years ran. They included the worst financial crisis since the Great Depression, the recovery, the European debt crisis, multiple corrections, and a long bull market. The final result, published in Buffett's 2017 letter to Berkshire Hathaway shareholders. The S&P 500 Index Fund returned a cumulative 125.8% over the decade, an annualized rate of about 7.1%. The 5 funds of funds after their fees returned a cumulative 36.3% on average, an annualized rate of about 2.2%. In dollar terms, $100,000 in the index fund grew to roughly $225,800. The same $100,000 in the average hedge fund portfolio grew to about $136,300. The worst of the 5 fund of funds portfolios grew to just $102,800 over the entire decade. After 10 years of professional management, that investor had earned less than 3% per year, total. It was not close. What the bet demonstrated is not that hedge funds are bad. Some of those underlying managers, individually, may have been brilliant. The point is structural. Once you layer 2% management fees plus 20% performance fees on top of returns that already have to clear the index, the math becomes nearly impossible. The fees compound against you with the same geometric force returns are supposed to compound for you. Over 10 years, that drag was enough to leave the average professional money manager behind a fund that, by design, was doing nothing more than buying everything. This is the empirical answer to whether sophisticated active management beats passive indexing for the ordinary investor. From the most public test ever conducted, the answer is no. How does an ordinary salaried person actually deploy capital into an index, given that the market does not move in a straight line and given that almost every entry point will, at some moment, look like a terrible decision? The strategy that solves this problem is one of the oldest, most boring, and most reliable mechanisms in personal finance: dollar cost averaging. The basic idea is that you invest a fixed dollar amount at fixed intervals, every month, every paycheck, regardless of what the market is doing. You do not try to time it. You do not wait for a dip. You do not sell on a spike. You simply buy on schedule. This sounds embarrassingly simple, and that is precisely why most investors abandon it. It feels passive. It feels like you are doing nothing. But the mathematics underneath are quietly powerful, and become most powerful in exactly the moments the strategy feels most painful. Consider what happens during a market decline. You are buying a fixed dollar amount of the index each month. As the price falls, that same fixed amount buys more shares. Your cost basis is being lowered mechanically by the act of continuing to buy. You are loading up on the asset precisely when it is on sale, which is what every investor claims they want to do, and what almost no investor actually does in practice, because falling markets feel terrible. A concrete example, because the strategy looks weakest in exactly the scenarios where it actually wins. Imagine an investor who began dollar cost averaging into the S&P 500 in October 2007, the worst possible moment, the absolute peak before the 2008 financial crisis. They invest a fixed amount every month, mechanically, regardless of news. They watch the index fall 57% over the next 18 months. Their portfolio goes red on every statement. Most retail investors at this point would stop. They would sell. But the investor who simply continues, who buys the same dollar amount every month, including throughout 2008 and 2009, is buying shares at progressively lower prices the entire way down. By 2010, with the S&P 500 still nowhere near its 2007 high, that investor's average cost basis is dramatically lower than the original entry price, because the bulk of their shares were purchased during the decline. By 2013, when the S&P 500 finally recovered to its 2007 peak, this investor was significantly in the green. This is the curve practitioners call a smile. The price drops, you keep buying, the price recovers, and the recovery brings the entire accumulated position into profit. The worse the dip while you were buying, the better the eventual return, provided you keep buying. What dollar cost averaging is, fundamentally, is a mechanical workaround for the fact that humans are bad at buying low and selling high. Every behavioral finance study ever conducted has found the same pattern. Retail investors put the most money in near-market peaks, when sentiment is euphoric, and pull money out near market troughs when sentiment is fearful. They do the opposite of what they should, almost without exception. Dollar cost averaging eliminates the decision. There is no buying or selling judgment to make. There is only a calendar. But dollar cost averaging alone is not optimal, especially when valuations matter, which they do. There is a long-running debate in finance about whether valuation matters for index investors. The strict passive view associated with Bogle is that valuation is irrelevant. Just buy on schedule, hold forever, ignore the price. The historical record largely vindicates this view for investors with truly long time horizons. But a more nuanced view, supported by a substantial body of academic work, says valuation does matter, not for predicting next year, but for predicting the next decade. And right now, that distinction is unusually important. The single best-known metric for this is the cyclically adjusted price-to-earnings ratio, the CAPE ratio, developed by Yale economist Robert Shiller. It is constructed by dividing the price of the S&P 500 by its average inflation-adjusted earnings over the prior 10 years. The 10-year averaging smooths out the effect of recessions and booms on corporate earnings, producing a valuation signal far less noisy than a simple price-to-earnings ratio. Shiller's data extends back to 1871. Over that entire period, the historical median CAPE is around 16. The historical mean is closer to 17. There have been periods when CAPE compressed to single digits, most famously 1932, at the bottom of the Great Depression, when it hit roughly 4.7. There have been periods of extreme overvaluation. The peak before 929 was around 32. The peak before the 2008 financial crisis was around 27. The all-time historical peak was December 1999, at the height of the dot-com bubble, when CAPE briefly touched 44.19. As of May 2026, the CAPE ratio for the S&P 500 is approximately 41. That is the second highest reading in over 150 years of U.S. market history. Higher than 1929, higher than 2007. Only the dot-com peak of 1999 was richer. I want to be careful about what this does and does not mean. It does not mean the market is about to crash. CAPE has terrible short-term predictive power. It has been elevated for most of the last decade, and during that decade, the S&P 500 still produced strong returns. Market timing on CAPE alone would have kept you out of one of the best bull markets in history. What CAPE has instead is medium-term predictive power. A large body of academic work shows a strong negative correlation between starting CAPE and the subsequent 10-year real return. When CAPE starts above 30, the next decade's annualized real returns have historically been low single digits, sometimes negative. When CAPE starts below 10, the next decade has historically produced double-digit real returns. The relationship is noisy at any single point, but unmistakable across the full dataset. The practical translation: at a CAPE near 41, the next decade is unlikely to deliver the same 10% annualized returns the S&P 500 has historically averaged. Future returns will likely come from earnings growth and dividends, not from further multiple expansion. This does not mean sell. It means adjust expectations. And more importantly, it means that if and when valuations eventually compress, that compression will represent a genuine opportunity, and you should be prepared to deploy aggressively when it happens. What follows is the operational system, the actual mechanics, how a salaried worker with no special skills deploys capital through a market cycle to maximize the probability of arriving at financial independence between 35 and 45. This is not a trading strategy. It is a deployment framework. It tells you, on any given month, what percentage of your investable savings should be flowing into the market based on where valuations stand. And it tells you, when valuations get extreme, exactly how to exit a meaningful portion of the position. The framework is not designed to beat the market. It is designed to do something more modest. Stack the odds slightly in your favor at the entry points and protect a meaningful portion of your gains at the exit points. Over 30 or 40 years, those small edges compound into something substantial. The first principle is the pyramid structure on the way in. You begin by identifying your investment vehicle. For US-based viewers, VOO or IVV. For non-US viewers, VVAVURA or its dividend distributing equivalent. Then you set deployment tiers based on the CAPE percentile, which you can look up freely at sites like multiple.com or Guru Focus. The percentile tells you, relative to a historical look-back window, how cheap or expensive the market is right now. When the CAPE percentile is between 40 and 80, the historical normal range, neither cheap nor expensive, you simply deploy your regular fixed monthly amount. 1 unit every month, no adjustment. When the CAPE percentile drops below 40, the market has entered cheaper territory than 2/3 of its recent history. You step up to 1.5 units per month. When the CAPE percentile drops below 20, which historically has only happened during major bear markets, you double up. 2 units per month, sustained. When the CAPE percentile drops below 5, what happened at the bottom of 2008 and briefly during the March 2020 collapse, you deploy aggressively, bringing in capital you had been holding in reserve. This is the moment the entire system was designed to capture. Almost no one will do this in real time, because by definition, the news will be apocalyptic and your portfolio will be deeply in the red. But this is exactly the moment when the next decade of returns is being priced in. The mechanical effect is that over a full market cycle, the average cost basis of your accumulated position is significantly below the average price of the index over the same period. The harder problem is selling. Most academic finance argues you should never sell. Just hold forever, let dividends and earnings compound, and ignore the noise. For investors with infinite time horizons, this is correct. But for someone trying to between 35 and 45, with 30 or 40 years of withdrawal ahead, partial profit-taking at extreme valuations becomes defensible. Not because you will time the top, but because you will reduce the sequence of returns risk we will address shortly. A simple, mechanical exit rule. When the CAPE percentile rises above 80, meaning the market is more expensive than 80% of its recent history, you begin a staged exit, the framework, 30-30-30-10. At CAPE percentile 80, sell 30% of the position. At CAPE percentile 90, sell another 30%. When the market makes a new all-time high in valuation terms, sell another 30%. The final 10% let ride into whatever bubble finishes the cycle. If the bubble blows further, you participate. If it collapses, you have already harvested 90% of the position at peak valuations. The mechanics are not magic. They are the inverse of the pyramid on the way in. Heavy deployment when cheap, heavy harvesting when expensive. In between, patience. Everything we have discussed so far concerns accumulation. The harder question, the one most fire content avoids, is what happens after you have the money. Because the act of withdrawing from a portfolio is mathematically asymmetric from the act of depositing into one, in ways that catch most early retirees by surprise. The foundational research here is a 1994 paper by William Bengen, a financial planner, published in the Journal of Financial Planning. Bengen wanted to know, what is the maximum percentage of a portfolio a retiree can withdraw in the first year of retirement, then adjust upward each year for inflation, such that the portfolio survives at least 30 years across every historical scenario, including the late 1960s retirees who got hit by 1970s stagflation, the 1929 retirees who walked into the Depression. His answer was approximately 4%. A retiree with $1 million could withdraw $40,000 the first year, adjust that figure for inflation each subsequent year, and survive 30 years in every historical sample period he tested. This became famous as the 4% rule. There are two important updates. The first, in 2025, Bengen himself published a new book, A Richer Retirement, updating his recommendation to 4.7%. His original analysis used a narrow portfolio of large-cap U.S. stocks and intermediate-term treasuries, expanding the equity allocation to include mid-cap, small-cap, micro-cap, and international stocks, improved historical resilience enough to support the higher rate. He now describes 4.7% as the worst-case starting figure, with many retirees able to safely withdraw higher depending on conditions. But, and this is the second update, cutting the other way, Bengen's research is calibrated to a 30-year retirement, someone retiring at 65, planning to age 95. The early retirement community has known for years that for retirement horizons of 40, 50, or 60 years, the math changes substantially. Academic work by researchers including Wade Pfau and Michael Kitzes has examined longer horizons and generally concluded that for a 50-year retirement, the genuinely safe withdrawal rate is closer to 3 to 3.5%, not 4 or 4.7. If you are planning to retire at 40 and expect to live to 90, do not use the 4% rule. Use something closer to 3 to 3.5%. On a $1 million portfolio, that is $30,000 to $35,000 in the first year, adjusted for inflation thereafter, not $47,000. There is a third consideration that matters even more than the headline rate, what academics call sequence of returns risk. The same average return, experienced in different orders, produces wildly different outcomes for a retiree. Two retirees with identical 30-year average market returns can end up in completely different positions if one retires into a bear market and the other into a bull market. The retiree who experiences poor returns in the first 5 years of retirement, while also withdrawing for living expenses, depletes principal far faster and may never recover even when the market eventually does. Withdrawal timing matters as much as withdrawal rate. Retiring at a CAPE of 41, as the market currently stands, carries materially higher sequence of returns risk than retiring at a CAPE of 15. Practitioners address this through what is called a bond tent, temporarily increasing bond allocation in the years immediately before and after retirement, then gradually shifting back to equities as the early retirement danger zone passes. The accumulation phase is just discipline. The withdrawal phase is engineering. Capital is one axis of compounding. It is the axis we have spent most of this video on because it is the most quantifiable. But it is not the only axis, and arguably not even the most important one for someone starting from a modest base. There are two others. They compound on different timescales, and they are nearly invisible from the outside, but they determine whether the capital strategy actually has a chance of producing the outcomes we have described. The first is what Naval Ravikant, in his Essays on Wealth, calls compounding through specific knowledge. The general version is simpler. The human brain, fed deliberately and consistently, produces compounding returns on decision quality. Reading widely across non-fiction builds a library of mental models that accumulates across decades. The compounding here is not in dollars. It is in the quality of every decision you make about career, investments, relationships, which opportunities to pursue and which to decline. Compound that over 30 years, and the gap between someone who has been reading deliberately and someone who has not is roughly the same gap that exists between a 10% compound rate and a 4% compound rate. Carol Dweck, the Stanford psychologist, distinguishes between a fixed mindset and a growth mindset. A fixed mindset treats abilities as innate and stable. A growth mindset treats them as developable through deliberate practice. The data she has accumulated over decades is unambiguous. The growth mindset population outperforms across nearly every measurable life domain: career, income, relationships, even health outcomes. The single most useful psychological framework to internalize, if you want compounding to work in your favor, is that your current capabilities are not your final capabilities. They are a starting point. The second additional axis is career compounding, and this is the most underrated of the three for early retirement specifically. Most people in white-collar jobs accumulate skills that are deeply specialized, one leg of a much larger machine. You are very good at one slice of a process, but you cannot run the whole process yourself. This makes you indispensable to your employer in a narrow way and entirely dependent on them in a broader way. The alternative is to deliberately build what I will call a complete operator skill set, the minimum set of capabilities required to run an entire small business or freelance practice on your own. Once you can run the whole machine, the relationship between you and any single employer changes. Your salary becomes one option among several rather than your only source of income. You can charge by the project rather than the hour. You can work from anywhere with a network connection. The leverage shifts. The practical method: use your day job as a paid training ground for the skills you are missing, while delivering at a level that earns you the more interesting work. Most jobs have a mix of routine tasks and high-leverage tasks. The high-leverage tasks are how you actually compound career capital. The routine ones you automate, delegate, or eliminate, and use the recovered time to learn the components you still lack. There are also things not to do. A short list. Do not gamble your health on chronic risks, addictions, sleep debt, anything that compounds in the wrong direction. Do not invest in pure consumption goods and call it investment. A depreciating object is not an asset. Do not deploy meaningful capital before you have read enough to understand what you are deploying it into. Do not chase yields above what we have established are the limits of what is physically achievable. Do not go all in on any single career, asset, or relationship. Leave margin. Do not borrow to invest, particularly in equities, particularly near valuation extremes. The strategy we have walked through is not exciting. It is not the version of early retirement the algorithm rewards. There is no trick, no secret, no edge. There is a system, supported by approximately a century of data, executed across 2 or 3 decades of patient mechanical deployment, alongside 2 other quieter forms of compounding that almost no one talks about. If that is something you can do, the math says you can retire between 35 and 45. If it is not, that is also a legitimate decision. But at least it will be a decision made from evidence, not from a thumbnail.